Hello students, in the last lecture we have studied introduction to partnership and the things which is included in the preparation of partnership final account. Now, how the partnership firm has came into existence to overcome the limitation of sole trading concern. So what are these limitations as we have discussed earlier, that is limited capital, then lack of specialization in work, then the overburden of work. So all these things are involved in case of sole trading concern. So to overcome these limitations, that partnership firm came into existence. Now when the partnership firm is going to set up, that how many partners are required, that is also the main point. So there are minimum 2 partners and the maximum 50 partners who can start or to run the partnership business. Now when we decide to form a partnership firm, that there must be a agreement between the partners, otherwise there will be a disputes among the partners on the basis of their profit sharing, right? So to avoid such disputes, there must be a written agreement between the partners, and that written agreement is called as a partnership deed. So then next thing that we have learned is about the partnership deed. What are its content? What should be included in the partnership deed? That all things we have studied in the last lecture. After that, the next thing that we have also studied is the partnership final account. Now, when we talk about the partnership final account, which includes the trading account, profit and loss account, and the balance sheet. What are the trading account purpose? Why the trading account is prepared? Then next we have studied the profit and loss account. What is profit and loss account? What is the purpose to make up or to prepare the profit and loss account? And then next, the last thing that we have prepared, which is a balance sheet. And as you all know, this trading account and the profit and loss account, these two are the account, but the balance sheet is not an account. It is a statement of what? The statement of showing financial position of the business. What is the financial status of the business? Whether they have enough assets to make payment of liabilities. So all those things we come to know with the help of the balance sheet of that particular business. Now after that, when we prepare the balance sheet, now previously in the part of sole trading final account, that only one partner was there and there is no need to make a separate capital account for the partner. But whenever in case of partnership firm or in case of final account of partnership firm, there are minimum 2 partners or maximum 50 partners. So if there are so many partners involved in any business activity, so we have to maintain the separate capital account for each partner. Suppose there are 2 partners, so when there are 2 partners, we have to maintain the separate capital account. So how their capital account should be maintained, that we are going to study. Now, when we want to maintain the capital account, there are 2 methods of maintaining capital account. One is a fixed capital method and the second is a fluctuating capital method. Now, first we will talk about the fixed capital method. Now, when we talk about the fixed capital method, see, okay, so when we talk about the fixed capital method, so the fixed capital method means the capital or the fixed capital method is a method where the capital is kept as a fix, that all adjustments which we usually do on the capital account, now these all adjustments should be done on the current account. So instead of capital account, the capital account balance should be kept fixed. See, that is why here the fixed capital method is given. That means capital account balance should be kept fixed and all the adjustments on the capital account, that should be maintained or that should be done on the current account. So the separate account is maintained to do all those adjustments, which is called as a current account. So it is easy to identify whether the fixed capital method is asked or a fluctuating capital method is asked. So whenever the fixed capital method is asked, along with the capital account balance, they have been provided with the current account balance. So along with the capital account, if the current account balance is given, so you can easily identify this is a fixed capital method. So what we need to do, that we just have to maintain the capital method as it is. We don't have to do any adjustment on capital account. That all adjustments which we usually do on the capital account, that all should be done now on the current account. Okay, so this is a format of fixed capital method, capital account under the fixed capital method. See here we take the balance brought down, that is opening balance of capital. Then next we have taken the additional capital brought by the partner. So if any additional capital brought, that has to be mentioned in the capital account only, because this is related with the capital. And if the capital brought in the form of any assets, so the total of these all assets is taken. See, no adjustment is done. There is no other adjustment except the capital account. Okay, so these two adjustments are regarding capital only, and that is why it is taken here. That all other adjustment like interest on capital, commission to partner, salary to partner, then uh, drawings, interest on drawings, that all adjustment is done on the current account. These are not done on the capital account. So here only capital related things are taken. So then we do the total of credit, same total is taken on the debit, and that whatever balance we got on the debit side is called as a balance carried down. So that balance of capital account is taken to the balance sheet. This is a capital account in the fixed capital method. The next account that we are going to maintain under the fixed capital method is a current account. This is a main account in case of fixed capital method. So as I said, that the adjustment which we usually do on the capital account, now in case of fixed capital method, that all adjustment should be done on the current account. See here, this is a current account balance, opening balance. If it is given on the credit side, so by balance brought down. If it is given on the debit side, then to balance brought down. So whatever, it may have debit or credit balance, but the capital should always have a credit balance. Now after that, the interest on capital, as I said, that adjustments are taken here: salary to partner, commission to partner, and the profit which we got from the profit and loss account, that is share in net profit. See, the share in net profit should be given to partner. Now instead of capital account, it is given in the current account. And then on the debit side, drawings, if any drawings made by the partner, that should be debited. Then whatever interest chargeable on these their drawings, it is also to be debited. Then profit and loss account balance. Now this profit and loss account means the share in loss. Suppose there is loss, net loss, so that loss should be given to the partner as we give profit to the partner. So same in case of loss, that loss should be also given to the partner. And after making all those adjustments, whatever balance we can get is called as a balance carried down. And now this balance should be transferred to balance sheet. Okay, so this is what the current account in case of fixed capital method. As I said, there are two methods of maintaining capital account. One is a fixed capital method and the second is a fluctuating capital method. So under fixed capital method, we can maintain two accounts. One is a capital account and the second is a current account. So instead of capital account, that all adjustment should be done on the current account. Then the second method that we are going to learn is the fluctuating capital method. So as I said, the name itself indicates that the fluctuating, the capital is going to fluctuate. It is not fixed. It is depends on the situation. Means if there are adjustments are there, then the capital account balance is changed. So we will see the fluctuating capital method. See the fluctuating capital method. See it, what they said under fluctuating capital. In this method, the amount of capital changes every year. So why it is going to change? Because that the part, all the adjustments, because of the general adjustments related to capital. So why it is going to change? It is because of the adjustments on the capital account. Now see, as I said, when the fluctuating capital method is asked, that there is no current account, there is no need to maintain the current account. So all those effect of adjustment should be given to capital account only. So in case of fixed capital method, we usually maintain the capital account and current account. So capital account, that all the adjustment should be done on the current account. We don't have to make any adjustment on capital account. But in case of fluctuating capital, here only one account we maintain, which is a capital account. Here the capital account is maintained, and that is why all the adjustments, see, in the last case, that all adjustment we made on the current account. Now these all adjustments are here on the capital account. If the additional capital made, if the interest on capital, if any salary payable to partner, if any commission payable to partner, that also come. Then share in profit or loss. So if there is a profit, that profit share should be given to partner. If there is a loss, that loss share should be given to partner. Along with that, drawings and interest on drawings, these adjustments are also there. So if you remember that in the last slide, that we have seen these adjustment in on the current account, because that method was fixed capital method, and this method is fluctuating capital method. And in case of fluctuating capital method, that all adjustment should be done on the capital account itself. There is no need to make any adjustment, or for there is no need to maintain any separate current account. So it is easy to identify whether fluctuating capital method is asked or a fixed capital method is asked. See, if the along with the capital account, if the current account balance is given in the question, you can easily identify this is the uh, fixed capital method, and if only capital account is given, then that can be considered as a fixed fluctuating capital method. Preparation of partnership final account. Now, final account is prepared on the basis of trial balance and the additional information provided. What is additional information? That additional information means those things which are incurred after closing down all the books of accounts. Once the books of accounts are closed, after that, if any transactions incurred, so these transactions can be considered as additional information, and that is why these are called as a adjustment. So on the basis of trial balance and on the basis of these additional information, the trading profit and loss account and the balance sheet, which is final account, is prepared. So first we will talk about the trading account. Now trading account is a nominal account. It is a type of nominal account, and that is why it follows the rule of nominal account, which says debit all expenses and losses, credit all incomes and gain. After that, the trading account is prepared to find the gross result of the business. So as you know, gross result means the gross profit or a gross loss. So trading account is prepared to find out the gross profit or gross loss of the business. See here it is given. So it is prepared to find out the gross profit or gross loss. So how the trading account is prepared? It is prepared on the basis of direct expenses and direct income. So direct expenses and direct income. Now what is direct expenses? It is explained in the last lecture also. Direct expenses means those expenses which are directly related to production activity, whatever production. So it is related to the direct production activity, or those expenses which are incurred in a factory. Then income means, direct income means those income which is directly came from the production. So these are called as a direct income and direct expenses. So on the basis of these direct income and direct expenses, profit or gross loss can be found. So direct expenses are recorded on the debit side and the direct incomes are recorded on the credit side. So when your credit side total, is more than the debit side, that is called as a gross profit. When your credit side total is more than debit side, for example, suppose this is your trading account. So if the credit side total is more than the debit side total, if credit side total is 2 lakhs as I shown, so same total is taken on the debit side. So whatever difference, if the debit total is 1 lakhs, so what is the difference? It is 1 lakh. So whatever difference we got on the debit side is called as a gross profit. So this is what your gross profit is. So when your credit side total is more than the debit side is called as a gross profit. Then what is then the gross profit, and when your debit side total, and in opposite of that, when your debit side total is more than your credit side total, the difference is called as a loss. See here, suppose this is again your trading account. So if your debit side total is 2 lakhs, debit side total 2 lakhs, so same total we taken on the credit side, and if on the credit side that amounts are rupees 1 lakhs 50,000, so whatever difference we got, that 50,000 is called as a gross loss. This is your gross loss. So that is how the gross profit or gross loss can be calculated. And then after this, gross profit and gross loss is next transferred to the profit and loss account. Afterward it is transferable to profit and loss account. So this is what the format of your trading account. This is our format of trading account. As I said, trading account is a type of nominal account. So it is a nominal account, and which is also called as a factory account. This is also your factory account. So if it is a factory account, so all the expenses related to the factory, as I said, all expenses and income which is related to the factory, that all comes in the trading account. Now if it is a nominal account, as I said, if it is nominal account, so nominal account follow the rule of nominal accounts. So what is the rule of nominal account? Debit all expenses and losses. So on the debit side, all expenses and losses are recorded, and credit all incomes and gain. On the credit side, all incomes and gains are recorded. Okay, so on the debit side, all in expenses and losses, and the credit side, all incomes and gain. But which kind of expenses? The direct expenses. It is prepared on the basis of what? Direct expenses. And on the credit side, it will be direct income. This is also very important. Direct income. So on the credit side, all the direct incomes are recorded, and on the debit side, all the direct expenses are recorded. That means those expenses which is directly related to the production activity, right? So what are these expenses? First, opening stock is there, then purchases less return outward. Return outward means purchase return. This is also called as a purchase return. So if we purchase a material of rupees 1 lakhs, out of that 1 lakhs, the 20,000 rupees material is received of bad quality, or if it is destroyed or damaged in transit, so we cannot keep that material, so we return that material to the seller, and whatever material return, that should be deducted. See here, it is less. So from purchase, that return outward is deducted, and whatever net purchases, it is taken on the credit side. So after that, next thing is on debit side is a carriage inward. Carriage inward means it is a carrying cost of material purchase. So when we purchase any material, for carrying this material, whatever loading unloading charges are there, that all has taken under the carriage inward. So it, the carriage inward is taken on the debit side of trading account, because it is related to the purchase of material. If it is, if the carriage is paid at the time of sale of material, so if it is related to the selling activity, so it should come under the profit and loss account, which is also called as a carriage outward, but this is your carriage inward. So carriage inward means it is paid at the time of purchase of material. So whatever things which is related to the purchases, again taken to the trading account. The next is a freight, then dock charges, custom duty. So these are the charges payable to the government, or taxes in the way of taxes. Then wages, wages and salary. See, wages and salary. If only wages and salary is given, it is taken to the trading account. Then import duty. That import duty is paid at the time of importing the material. If sometime the material is purchased from outside the country, so at that time import duty should be payable. So this is again related to the purchase, and that is why it is taken on the debit side. Then coal, coke, gas, motive power, oil, water, or grease. So these are the things which is required to run the machineries. And where your machinery is lied, it is there in the factory. So all those expenses which is related to the factory, as I said, again it is taken to the trading account. Then royalty on purchases, primary packing charges, factory lighting and heating, factory rent rates, factory insurance, worksman salary. Works means the factory only. So worksman salary means factory manager's salary. So works is the another word for the factory. So these all are the expenses which is related to the factory, and that is why that all are called as a direct expenses. So that is why if it is a direct expenses, that all are taken on the debit side. Now these are the direct expenses. After that, on the credit side, see, first sales is taken and return inward. As we deduct return outward from the purchases, so we deduct return inward from the sales. Return inward means it is a sales return. So sales return is deduct from the sales, and after that, after deduction of that amount, that whatever amounts we got is called as a net sales. After that, goods lost by fire, goods lost by theft, goods distributed as a free sample, goods lost in accident, goods withdrawn by partners. So all these things are taken on the credit side of your trading account, and along with that the closing stock. This is the last thing that we have taken on the trading account credit side. After that, so this is what the format of your trading account. It is not necessary that all items should come to the trading account. Out of this, some items are given in the questions. So on the basis of that, the trading account is prepared. After that, as I said, how the gross profit is calculated: when your credit side total is more than debit side. If these items of credit side is more than these items of debit side, so we do the credit side total first, then same total is taken on the debit side, and from that the items which is given on the debit sides are deducted, and whatever difference we got is called as a gross profit carried down. See, it is given here. So this is your gross profit carried down. In the opposite, when your debit side total, when the debit side items are more than your credit side items, so the same, if the total is taken on the debit side, same total will be taken on the credit side. Same total is taken on the credit side, and from that these items are deducted, and whatever difference we got is called as a gross loss. This is how the gross profit or gross loss can be found. It is prepared on the basis of direct expenses and direct income. See, on the debit side all the direct expenses are recorded, and on the credit side all the direct incomes are recorded, and it follows the rule of nominal account, and that is why debit all expenses and losses, credit all incomes and gain. But which incomes? Direct income. Which expenses? Direct expenses. So basically trading account is prepared to on the basis of direct income and direct expenses to find the gross result of the business. This is the second account that we are going to maintain under the partnership final account, which is called profit and loss account. Now on the basis of profit and loss account, net profit and net loss can be found. Now the profit and loss account is a type of, again, nominal account. It is a type of nominal account, and as you know, if it is a type of nominal account, it follow the rule of nominal account, which says the debit all expenses and losses, credit all incomes and gain. Now the profit and loss account is prepared on the basis of indirect income and indirect expenses. So it is prepared on the basis of indirect income. See, it is prepared on the basis of indirect expenses and all the basis of indirect income. So the indirect expenses are recorded. It is recorded on the debit side. As I said that expenses, this is a nominal account, and if it is a nominal account, debit all expenses and losses. So all expenses and losses on the debit side. But which kind of expenses? All the indirect. As I said in the last account, that is in the trading account, all the direct expenses are taken. So direct expenses means those are directly related to the production activity. So in case of profit and loss account, all the indirect expenses are taken, and indirect expenses means those expenses which is not directly related to the production activity. That means those are indirectly related to the production, or those are indirectly related with the product, and that is why these are called as a indirect expenses. And the same indirect income means those income which is not from the production, or if our main business is to make a furniture, so whatever incomes we got by making furniture or by selling furniture is called as a direct income. But apart from that, whatever incomes we are getting, like when we made any investment, when in the shares, or it may be in the debentures, so on that shares and debenture, whatever dividend or whatever interest that we receive, then sometimes one of our office, if we gave on the rental basis, so on that office whatever rent we are receiving, that is again one of our income. So suppose if we sold one of our assets, and on that assets whatever profit we are getting, so these are the incomes, but which is not from the production. Our production is to make a furnitures, so it is not related to the furniture, but still we are getting that income, and that is why such incomes are called as a indirect income, because this is not related to the production, and still we are receiving these incomes, and that is why these are indirect income, and that is why it is taken on the credit side. As I said, if debit all expenses and losses, then credit all incomes and gain, and that is why all incomes and gain should be credited, gains. So basically profit and loss account is prepared to find the net result of the business. What is net result? Net result means net profit or net loss. It is prepared to ascertain. See, it is prepared to ascertain what? Net profit earned or a net loss suffered by a business. So business, whether it is earning profit or loss, that we all come to know with the help of that profit and loss account. Now, after preparing profit and loss account, that how to identify whether there is a net profit or a net loss. So when the credit side total is more than the debit side, as I said, if on the credit all incomes and gains are recorded, so if the incomes and gain is more than the expenses we incurred, for example, for making, as I give an example, for making a chalk, if we spend 5 rupees on the preparation or on the production of that particular chalk, so if we spend 5 rupees and in the market if we could sell that material or that pen or that chalk for rupees 10, so whatever extra amount we are getting, if we spend 5 rupees, if I purchase that chalk for rupees 5 and if I sell that chalk for rupees 10, so the extra amount that I am getting is called as a profit. So when your incomes are more than your expenses, the difference is called as a profit, and when the expenses are more than the incomes, the difference is called as a loss. So that is what your profit and loss account. Now this is a format of profit and loss account. Now profit and loss again follow the rule of nominal account. As we already see, it follow the rule of nominal account. And what is the nominal account? Says debit all expenses and losses and credit all incomes and gain. So on the debit side of profit and loss account, all expenses and losses are recorded, and on the credit side of profit and loss account, all incomes and gain are recorded. So now which kind of expenses? In trading account, all the direct expenses are recorded, and in profit and loss account, all indirect expenses. So on the debit side, all indirect expenses. So all these items which is given on the debit side of profit and loss account is indirect expenses. Indirect means those expenses which is indirectly related to the production activity, indirectly, not directly. And on the credit side, all indirect incomes are recorded. So indirect income means, as I said, that indirect expenses means those incomes, indirect income means those incomes which is apart from the production activity. So all those expenses and incomes are taken here in the profit and loss account. Now we will discuss one by one. Now the first thing is a salary, then salary and wages. So these are the expenses which is paid in the office. So basically trading account is a type of factory account, and the profit and loss account is a type of or where the office and administration related activities and where the selling and distribution related expenses are taken. Okay, so here the salary, then salary and wages, rent, insurance, electricity, lighting, telephone or postage, printing and stationery, traveling expenses of salesman. So this is related with your selling activity. So these expenses are related to the office and administration. So this is related with your office and administration. See, if you could see that salary and wages, rent, insurance, electricity, telephone, printing charges. So these are the expenses which are payable in an office, and that is why it is taken in the profit and loss account. So these are related with the office and administration activity. Then traveling expenses of salesmen. So the traveling expenses of salesmen, it is related with the sales. Then depreciation on assets. So depreciation on all assets, whether it is on the plant and machinery, furniture, building, land. So all depreciation should be taken under the profit and loss, because depreciation is what? It is a reduction in the value of fixed asset. So if the value of assets is getting reduced, there is loss, it is our loss, and if it is loss, it should be debited to profit and loss account, because the debit says all expenses and losses. So these, if this is expenses, so the depreciation is a loss, because it is going, because of depreciation the value of assets is going to reduce, and that is why it is taken on the debit side. Then loading charges, if uh, if we are making sales, so at the time of sales whatever loading charges we paid, that also debited. Then audit fee. Now audit fee means it is a charges payable to the auditor. So who is the auditor? Auditor is a person, he is a he is a person who is a chartered accountant, who is appointed to check whether the account maintained by a businessman is properly maintained, or whether the rules or the whatever accounting principle that been followed while making these accounts. So whether the accounting principles are properly followed or not, that all things are checked by the chartered accountant, and whatever fees charged by him is called as an audit fee. He is also called as an auditor, and that is why that audit fee is also taken on the debit side. Then entertainment expenses, repairs, renewals, maintenance, interest on loan. So if any loan taken, on that loan whatever interest payable is again our expenses, and that is why it is taken on the debit side. As I said, see, if you remember in the last lecture, that the expenses or the amount which is already paid is called as expenses. The amount which is already paid is called as expenses, and the amount which is payable in the future is called as a liability. So that difference we should identify. Whenever the trial balance is given, we should identify whether on that such matter the expenses is actually incurred. If it is actually incurred, then it is taken to the profit and loss account debit side, and if it is payable in the future, then it should be taken on the balance sheet liability side. So these are the things where we already make the payments. Then sundry or miscellaneous expenses, convenience, loss by fire, loss by theft, loss in accident. So these are the loss. So as I said, the debit all expenses and losses, and that is why that loss is also taken on the debit side. Then goods distributed as a free sample. Now the goods distributed as a free sample. Why the goods is distributing as a free sample? If any company, if they are introducing new product in the market, if we don't know anything about that particular new product, so if we don't know, we are not going to purchase that product until and unless we don't know the features or the specification of that particular product. So for that purpose, that company give free of cost. So once we got it as a free sample, so then we will use it, and once we use it, we will, if we like the features, if we like the product, so next time instead of taking as a free sample, next time we are going to purchase the same product. So this is one of the kind of advertising policy which is adopted by the businessmen whenever they introduce a new product. So this is again a advertising policy. If it is advertising policy, so this is related with the selling or the distribution, or advertisement is related with the selling and distribution. Then commission allowed or a commission given, discount allowed. Now discount and the commission, see here the discount and commission is given. So when discount and commission is given on both the side, see, basically the discount and the commission, these two items are given on both the side of your trial balance. So do not get confused. If it is given on the debit side, that should be taken on the profit and loss account debit. If on the trial balance debit side, if the discount and commission is given, it is taken on the debit side. And if the same discount and commission given on the credit side, so it is taken on the credit. See, it is given here also, see that this commission received and discount received, so it is given on the credit side. So it is a simple thing to identify. If the debit discount is given, just taken on the profit and loss account debit side. If credit discount is given, just took it on the credit side. Same in case of commission also. If the debit commission is given, taken, just take it on the debit side. If credit commission is given, take it on the credit side. See, basically debit is what? It is expenses and losses. Debit all expenses and losses, and credit is what? All incomes and gain. Credit is your incomes and gain, and that is why that received means we are receiving that, so that is why it is taken on the credit side. After that, allowances, advertisement, carriage outward. See, in case of carriage inward, as I said, it is a carrying cost paid at the time of purchase the material. So same, the carriage outward means it is a carrying cost which is incurred at the time of selling the material. So when we sell material, so at that time from our warehouse to the purchaser's warehouse, that whatever carrying cost incurred, it is incurred by the seller himself, and that is why this is related with the sales, and that is why it is taken to the profit and loss account. As I said, that all expenses which is related to the office and administration, selling and distribution, that all are taken to the profit and loss account. Then next is a sales charges, bad debts. Now the next is a bad debts. Bad debts means the debts which is not recoverable from the debtors. So debtor is what? Debtor is a customer, and when the customers are created, when there is a credit sales, customer कब create होते हैं? जब हम credit पे sell करते हैं. सो क्रेडिट पे अगर सेल हुआ रहेगा तो कस्टमर क्रिएट होते हैं, और कस्टमर से जो पैसा आने वाला रहता है उसे क्या बोलते हैं, डेटर्स. So when the debtors fails to pay their amount is called as a bad debt. So it is related again to the sales, right? The bad debts is a debts which is not recoverable from the debtors, and whatever things which is not going to receive is our loss, and if it is loss it is taken on the debit side. Then export duties, see, the import duty is taken at the time of preparing trading account because it is related with the purchases, and the same, the export duty is related with the sales. Export means sales. So uh, that is why the things which is related with the sales and the office that is taken here. Then taxes, general expenses, trade expenses, legal charges, professional charges, bank charges, solicitors fee, secondary packing charges. See, primary packing is taken there and the secondary packing is taken here. Loss on sale of fixed assets, see, at the time of selling any one of our assets, if there is a loss incurred, so that loss is a again expenses which is not related with the production. It is not directly related to the production. It is one of our assets which we want to sell, and on that assets if the loss is incurred, if the profit, sometimes profit may incur, so if the profit is there it is taken on the credit. See, here it is given on the credit side also, the profit on sale of assets. So if the profit is there it is taken on the credit side, and if the loss is there it is taken on the debit side. So that is how the things are transferred. So that is the things which is there on the debit side. So these are the debit items which are indirect expenses. So these all on the debit side, all are on the debit side are the indirect expenses. Then we will see the credit. As I said, the debit all expenses and losses, so the credit all incomes and gains. So on the credit side there must be all incomes and gains. See, commission received, discount received, interest received, dividend received, rent received, miscellaneous received, profit on sale of assets. So these all things that we are going to receive, and that is why these all are our income. So that is indirect income. So these incomes are not related with the sales, that main production. Our main production is what? Our main production is to make a furniture. So the income which is received from the making furniture is our direct income, and these are the incomes which is not related with the furniture, and that is why these are indirect incomes. See, the commission received, discount received, interest received, dividend received, so these are not directly related to the production, these are indirectly related to the production, and that is why this income is called as a indirect income. Okay, after that, so basically why the profit and loss account is prepared? That profit and loss account is prepared to identify the net result of the business. So what is net result? Whether the net profit or net loss. So same concept, how to calculate the net profit? When the credit side total, because credit including your incomes and gains. So when your credit side total, when the total of these credit items is more than the total of the debit item. Suppose the credit item total is 5 lakhs, that credit total is 5 lakhs, and the debit side total is 2 lakhs. So the basically your credit side total is more, so the same total is taken on the debit side, and from that 2 lakhs items are deducted and the difference is 3 lakhs. So whatever 3 lakhs profit we got, that 3 lakh is our net profit. This is called as a net profit. So the net profit, when we got the net profit, that will be distributed among the partners. So if the fixed capital method is there, so in that case that profit is transferred to current account, and if the fluctuating capital method is there where only capital account should be maintained, that time that profit is transferred to capital account only. But it is again to be given to the partners. If there are two partners, that should be given to two. If there are five partners, it should be given to five. If there are 10 partners, it should be given to all the 10 partners. So that should be distributed among their as per their profit sharing ratio. Same, this is in case of profit. So when we can say there is a loss, when your debit side total, when the expenses are more than the income. So in opposite of that, suppose debit side total is 5 lakhs and the credit side total is 2 lakhs. So credit के जो सभी items है उनकी total अगर 2 lakhs है और डेबिट के टोटल है जो उनका 5 lakhs है, so वही टोटल हमने क्रेडिट पे लेना है, और जो क्रेडिट में डिफरेंस आएगा, that credit difference is called as a net loss. See, it is given net loss. And again, if the profit is given to the partners, then the same loss, if the loss is there, that should be given to partners only. If there are two partners, it should be given to two. If there are five partners, it should be given to five. And if there are 10, 20, whatever number of partners are there, It should be given to all those partners. That is what the profit and loss account is. Okay. Now the third thing from the final account that we are going to study is a balance sheet. Now as I said that trading profit and loss account, these two are the accounts, and the balance sheet is not an account. Balance sheet is a statement. So if it is a statement, it does not have a debit or credit side. See, in case of trading profit and loss account, the left hand side is a debit side and the right hand side is a credit side. But in case of balance sheet does not have a debit or credit side. It has a liability and assets. The left hand side is a liability side and the right hand side is a asset side. But for our understanding, the liability side means the credit side and the asset side means debit side. See, in case of balance sheet, that opposite sides are there. Basically, this side is debit side in case of trading profit and loss account, but in case of balance sheet, this side is credit side. And in case of trading profit and loss account, this side is credit side, but in case of balance sheet, the same is a debit one. So the balance sheet is a statement which shows the financial position of the business. So financial position means the position of assets and the liabilities, whether we have enough assets to make the payment of liabilities. That position shows by the assets. Okay, see here it is given also given that the statement showing the financial position of the firm on the particular date, it is on the particular date. So one more important thing is that the trading profit and loss account, that whatever things there in your trading profit and loss account is pertaining to that particular year only. That is why when we prepare trading profit and loss account, there we write for the year ended. That means these figures are related to that particular year only. That is why there we usually write for the year ended. But in case of balance sheet, we do not write for the year ended, we write as on. So the balance sheet as on means the balances as on that particular date, as on 31st March 2020. So these are, if these balances on the 31st March 2020, in the next year when we close next year account, that is on 31st March 2021, so at that time the assets are same, these assets will remain same, but the thing is that the balances are different. So if the land and building value this year is 10 lakhs, so it may increase in the next year or it may decrease in the next year. So that is why when we prepare the balance sheet, the balance sheet is as on. So these balances are as on that particular date. Next year the balances may be different, it may be increase or it may be decrease, because if the depreciation is there, so the balances are going to decrease. If the appreciation is there, the balances are going to increase. And that is why in case of balance sheet it is written as on, and in case of trading and profit and loss account we write as a for the year ended. So that means these balances are pertaining to that particular year for the year ended. So for example, rent, sometime for example, if we paid the office rent, if this year our office building or whatever office premises we have, if it is on a rental basis, so this year we have to pay the rent. But the same office when we purchase, if it is purchased in the next year, so the rent is not payable. If the office is our own, in our own custody, if we purchase that office for our own, so there is no need to pay rent for that office, and that is why the rent may not be there in the next year. So that examples may be there. So that is why in case of trading and profit and loss account, the expenses which is there in the current year, it may not be in the next year. So it depends, and that is why there we usually write for the year ended, and here we write as on. So these are some balances of assets and liabilities. Let's see, the first goodwill is there. So goodwill is, it is an assets, it is an intangible assets, we cannot see, we cannot touch, we cannot feel, but still it is there. So it is a monetary value or monetary reputation, value of reputation of the business, that is called as a goodwill. Then land and building less depreciation, if the depreciation is there, so that should be deducted. See, depreciation less, so if the depreciation is there, that should be deducted. If the appreciation is there, it should be added. Same plant and machinery, then furniture and fixture, equipment, delivery or a motor van, leasehold or a freehold premises, patents, loose tools. So these are our fixed assets. These are our fixed assets. After that, the investment. So if we made some investment, so this is again assets. See, the basic thing is that assets means those things from which the amount is receivable in the future. ये सभी चीजें जिसमें से हमें फ्यूचर में अमाउंट मिलने वाला है इज कॉल्ड एज एसेट्स. द बेसिक थिंग. सपोज मेरा फर्नीचर है, सो फर्नीचर बेच के फ्यूचर में मुझे पैसा मिलेगा, सो जिसमें से भी फ्यूचर में पैसा आने वाला है दैट ऑल आर कॉल्ड एज एसेट्स. एंड द सेम इन केस ऑफ लाइबिलिटी. सो लाइबिलिटी मींस द थिंग्स फॉर विच द अमाउंट इज पेएबल इन द फ्यूचर. ऐसी चीजें जिसके लिए हमें फ्यूचर में पैसा पे करना पड़ेगा, एंड दीज आर कॉल्ड एज अ liabilities, and that is why these are taken on the liability side. So while differentiating between the assets and the assets and the income means the amount for which we already received. जो अमाउंट हमें पहले मिल चुका है उसे इनकम बोलते हैं, और जो अमाउंट हमें फ्यूचर में मिलने वाला है जिस चीज से, उसे क्या बोलेंगे? एसेट्स. सेम इन केस ऑफ लाइबिलिटीज एंड एक्सपेंसेस. एक्सपेंसेस मीन्स फॉर विच द अमाउंट इज ऑलरेडी पेड. जिसके लिए हमने पैसा पहले ही पे कर चुके हैं, दैट इज कॉल्ड एज एक्सपेंसेस. एंड द लाइबिलिटीज मीन्स फॉर विच द अमाउंट इज पेएबल इन द फ्यूचर. जिसके लिए मैं फ्यूचर में पैसा पे करने वाले हम लोग, दैट इज कॉल्ड एज अ लाइबिलिटी. Okay, so that is the difference between the liability and expenses, assets and income. Okay, after that investment is there, stores and spare parts, prepaid expenses. Outside prepaid expenses means the expenses which is advancedly paid. So if it is paid in advance, there is no need to pay it again, and that is why it can be treated as assets. Outstanding income, loans and advances. Closing stock. See, the closing stock means the stock which is remain unsold at the end of the period. So if it is remain unsold at the end of the period, the same stock can be sold in the current accounting year, and that is why whatever amount receivable from anything, that is treated as asset. Then debtors. So debtor is a assets. So what is debtor? The person from whom the amount is receivable, the customers from whom the amount is receivable. जिनके पास से भी पैसा आने वाला है, जिस भी चीज से पैसा आने वाला है, is our assets, and that is why it is taken on the asset side. Then bills receivable, cash in hand, cash at bank. So these all are treated as a assets, and that is why it is taken on the asset side. Then on the liability side, first a capital account is taken. See, and if the current account balances are also given along with the capital account, that capital account balance should be kept fixed, and all the adjustment should be done on the current account. Separately we will maintain the current account that we have already seen in the previous slides. Then general reserve of profit and loss, loan on mortgage. So sometimes the company or the businessman needs additional loan. So if they took loan from the bank, sometimes the loan is taken by keeping any one of our assets as a security. See, whenever you want to take any loan, that bank is not going to give directly. They will check your creditability, whether you are capable to repay that loan or not. So on the basis of that, the loan can be given by the bank. So the bank, if you are a businessman and if you are going to bank for a loan, so they will ask some of to keep any one of your assets as a security, so that the loan on mortgage is that type of loan. Then bank loan, loan from partners. Sometimes we took loan from the partners also. Sometimes the loan is taken from the partner's wife, partner's brother. So these loan are repayable in the future. That amount is receivable in the current, but it is repayable in the future. So the things which is repayable in the future is called as a liability. Then bank overdraft. So the bank overdraft means it is one of the temporary facility given by the bank to draft the amount, to overdraft the amount. It is one of the facility. Suppose if we want to make any urgent payment, but if we don't have the enough amount in our bank balance, so the bank gives a facility to the current account holder to overdraft the amount. Suppose we have 2 lakhs in the bank, and if we want to make a payment of 2 lakhs 50,000, so the 50,000 which is extra amount required is the facility given by the bank. We can draft the extra amount, and this is type of loan. So as and when you have amount in your bank account, bank will automatically deduct that amount, and that is why it is on the liability side, because it is repayable. Now the bank is giving us facility to overdraft the amount, and that is why it is repayable as and when we available. Then creditor, as the debtor is a person from whom the amount is receivable. Same as the creditor also. Creditor means the person to whom the amount is payable. That means the person from whom we purchase on a credit. अगर हमने उनके पास से क्रेडिट पे परचेस किया, सो उनको पेड करना पड़ेगा अमाउंट. सो दोज the amount which is payable is a liability, and that is why it is taken on the liability side. Outstanding expenses received in advance and the provision for taxes, so these all are the liabilities which is payable by the business, and that is why it is taken on the liability side. Okay, so now we have learned trading account format, profit and loss account format, and the balance sheet also. That is what the final account of partnership firm. See, the same things we have learned in the last year also in case of final account of proprietorship or a sole trading concern. Same things are there, but the difference is that in case of calculation of profit, when we prepare the profit and loss account, there we calculate net profit. In case of sole trading concern, that profit is given to the single owner, because the one person who is handling everything, he is the person who is investing amount, he is the person who is investing his managerial ability, he is the person who give everything to the business, and that is why he is the only one who is capable, or who is eligible to get that amount of profit only. But in case of partnership firm, there are different partners. Now you see, in this case there are three partners. So if there are three partners, so whatever profit earned by the business in profit and loss account, that should be given to all the three partners, because they are the partners. That is the main difference between the sole trading concern final account and the partnership final account. There the profit is given to the single person, and here the partners are there, and that is why it should be distributed among the partners.